Everybody talks about index funds versus ETFs like they're two rivals you have to pick a winner between. Here's the thing, nobody tells you. They're not even the same kind of thing. One is a strategy, the other is a structure. Comparing them the way most people do is like arguing over electric cars versus Toyotas. It's a category error. And once you see that, this entire decision that's been stressing you out basically dissolves. I know that sounds weird, so stay with me because by the end of this video, I'm going to give you one single question you can ask yourself that settles the whole thing in about 10 seconds. Not a chart, not a spreadsheet. One question. But first, let me say who this is really for. This video is for you if you're finally ready to start investing. You've got the money, you're motivated, you're ready to go. And then you hit these two terms that sound almost identical, and you freeze. Because you don't want to pick the wrong one on your very first move. So instead of picking either, you pick nothing and another month goes by. I need to be honest with you here, because I've been exactly that person. I put off my first investment for way longer than I'd like to admit. And it wasn't because I was lazy. It was because I was scared of making the wrong choice on stuff exactly like this. So if that's where you are right now, I get it completely. And I promise you by the end of this that fear is going to be gone. Real quick before we dig in, this channel is still small, and hitting that like button genuinely tells YouTube to show this to the next person who's frozen on this exact decision. Costs you nothing, takes 1 second, actually helps. Okay, let's clear this up. So let's start with the single most important thing, the thing that reframes this whole debate. An index fund is not a specific product. It's a strategy. It just means a fund that passively tracks a market index, like the S&P 500 or the total US market, instead of paying some manager to pick stocks. That's it. That's all index fund means. A strategy of tracking the market. An ETF, exchange trade fund, is not a strategy. It's a structure. It's a type of fund that trades on an exchange like a stock throughout the day. That's all ETF means. A wrapper, a package. And here's the part that breaks people's brains a little. A huge number of index funds are ETFs. The two categories overlap constantly. When you buy an S&P 500 ETF, you're buying an index fund that happens to come in an ETF wrapper. So asking index fund or ETF is often like asking, do you want juice or do you want a bottle? Those aren't opposites. You can absolutely have juice in a bottle. So what are we actually comparing? Because there is a real comparison hiding in here. What people really mean when they ask this is, should I buy an index mutual fund or an index ETF? Same strategy, tracking the same index just in two different packages. One packaged as an old school mutual fund, one packaged as an exchange traded fund. That's the real question. And now that we've named it properly, it actually gets easy. Let me show you what these two packages have in common first, because honestly, it's almost everything. Both give you cheap, diversified exposure to the whole market in a single purchase. Both can track the exact same index. You can buy an S&P 500 mutual fund and an S&P 500 ETF that hold literally the same 500 companies. Both are incredibly cheap now, with expense ratios often under 0.1%, sometimes as low as 0.03%. And both absolutely crush the expensive, actively managed funds that, statistically, fail to beat the market over the long run anyway. Over the long haul, their returns are basically identical. So please hear this. You are choosing between two genuinely great options. This is not a right answer versus disaster situation. It's more like choosing between two really good sandwiches. Relax. Okay, so if they're so similar, what actually is different? There are 5 real differences. I'll go through each one, and I'll tell you honestly how much each one actually matters, because some of them barely matter at all. Difference 1, how you trade them. An ETF trades all day long, like a stock. The price moves in real time, and you can buy or sell at any moment the market's open. An index mutual fund doesn't do that. It prices once per day, after the market closes. You put in your order, and you get that end-of-day price, whatever it turns out to be. Sounds like a big deal, right? For a long-term investor who's buying and holding for 20 years, it's almost completely irrelevant. Whether you got today's 2 p.m. price or today's closing price will not matter one bit in 2045. File this one under technically different, practically meaningless. Difference 2, the minimum to get in. This one actually matters, especially if you're starting small. With an ETF, the minimum is basically the price of one share. And tons of brokers now let you buy fractional shares starting at $1. With index mutual funds, some still have minimum initial investments of $1,000, $2,000, even $3,000 to get in the door, though that's been changing. And some are now $0. So if you've got $50 to start and you want to start today, an ETF usually lets you walk right in. This is a real practical edge for beginners with a small starting amount. Difference 3, automation. This one swings the other way. If your plan is to automatically invest the same fixed amount every single month, which by the way is exactly what you should be doing, index mutual funds are traditionally smoother at this. You tell it, invest $300 on the first of every month, and it just does it. including automatically reinvesting your dividends down to the exact dollar. ETFs can do this too now, but it depends on your broker. Some make automatic ETF investing easy, some make it clunky, or won't let you buy fractional shares automatically. So if you are a pure set it and forget it person, the mutual fund can have a real convenience edge here. Difference 4, taxes. And this one has a huge asterisk. In a regular taxable brokerage account, ETFs are structurally more tax efficient. Because of how they're built, an ETF generally won't stick you with a surprise taxable capital gain. An index mutual fund can actually pass a taxable gain onto you even in a year where you didn't sell a single share. Because when other people cash out, the fund sometimes has to sell holdings, and that gain gets spread across everyone. That sounds bad. And in a taxable account, it's a genuine point for ETFs. But, and this is the asterisk, this entire difference vanishes if you're investing inside a tax-advantaged account like a 401k or an IRA. In those accounts, these capital gains events don't hit you at all. So if you're investing in your 401k or IRA, you can basically ignore this whole difference. Just delete it from your brain. Difference 5. This one's sneaky, and it might be the most important of all. Your own behavior. Remember how ETFs trade all day in real time? That's not just a neutral feature. It's a temptation. When you can watch the price tick up and down all day and buy or sell with one tap, it quietly invites you to tinker, to panic sell on a red day, to time your buys. And the research is brutally clear. That kind of frequent emotional trading is one of the main ways regular investors wreck their own returns. An index mutual fund pricing just once a day has this beautiful built-in friction. There's nothing to stare at, nothing to react to. It quietly forces you to just buy and hold, which is exactly what works. So if you know, deep down, that you're the type to panic or fiddle, that once a day slowness might genuinely protect you from yourself. All right, 5 differences. Now here's the payoff I promised you, the one single question that settles this whole thing. Ask yourself this: what account am I investing in? That's it. That one answer decides it for almost everybody. Let me walk you through it. If you're investing through your workplace 401k, it's very likely you can't even buy ETFs in there. Most 401k plans only offer mutual funds, so your answer is basically made for you. Pick the low-cost index mutual fund tracking something broad like the S&P 500 or the total market. Done. If you're investing in an IRA or a regular brokerage account, you're starting with a small amount and you want the flexibility to just buy in with whatever you've got. An index ETF on the S&P 500 or the total market is the easiest front door. Low minimum, buy today, done. If your top priority is fully automating a fixed amount every month and never thinking about it again, lean toward the index mutual fund for that smooth automation. And if you're in a taxable account and you want maximum tax efficiency, lean ETF. See what happened there? You never actually needed to agonize over index versus ETF in the abstract. You just needed to know your account and your style, and the answer falls right out. Now here's the part I really need you to hear, and it's the honest heart of this whole video. The difference between these two good options is tiny. Genuinely tiny. We're talking about fractions of a percent and minor conveniences. But the difference between investing and not investing, between picking one and picking nothing, that difference is absolutely enormous. It's life-changing money over a few decades. And this is exactly the trap I fell into. I spent way too long frozen on tiny decisions like this one, comparing option A and option B down to the last detail. And the whole time, the real cost wasn't picking wrong. It was the months and months I spent not investing at all while I dithered. That delay cost me more than any expense ratio ever could. Don't do what I did. Quick note, I'm sharing how to think about this, not giving you personalized financial advice. Your account, your taxes, your situation are yours. So here's the whole thing in one breath. Index fund is a strategy. ETF is a package. They massively overlap. Both are cheap, diversified, and great. The 5 differences, trading, minimums, automation, taxes, and your own behavior, mostly matter at the margins. And the one question that settles it is simply, what account am I using? Answer that, pick the obvious match, and go. Here's what I actually want you to do this week. Don't rewatch this 5 times to trying to find the perfect choice. Just open your account, pick a low-cost fund tracking the S&P 500 or the total market, whichever wrapper fits your account, and make your first buy. That single action, imperfect as it might be, will do more for your future than another month of research ever will. If this finally made it click and took the pressure off, do me a favor and send it to someone you know who keeps saying they'll start investing soon, but never actually pulls the trigger. This might be the thing that gets them off the fence. And if you want more of this, Plain, honest money stuff with no hype. You know what to do. I'll see you in the next one.